I'm Austin Williams, and I'm here today with Justin Gartman. We are wealth coaches at Better Wealth, and we get this question that gets asked to us, which is basically like, how secure is life insurance, and how can I trust these carriers that issue these policies? And we thought that we got this question enough that we were going to put some material together today, go through it about what you're essentially trusting when you get a policy and what these carriers are doing with your money. And then ultimately we're going to circle back around and then kind of answer the questions, like the kind of the specific questions that people have. Do you have any thoughts before we get started on the security of life insurance, Justin?
Yeah, I know it's something that we get all the time, something we talk about. Hey, safe place to store money, liquid, all of those good things. So we're going to answer the question today of exactly how is it safe, why is it safe, and excited to see what you have today.
Absolutely. Yeah, me too. Me too. So we're going to start with like a 30,000 foot sort of level look at like essentially how does life insurance function? How do these carriers operate? And then we're going to kind of get closer and closer to Earth from there. So we'll go here. So I'm going to share my screen quickly so that you all can see what we're seeing. So the security of life insurance. Now, how does life insurance work? So what happens? So when you get a policy, you have to fund the policy with something called premium, and the premium buys death benefit. That's the very kind of basis foundation, the chassis, if you will, of life insurance. And your premium dollars get combined with all of the other premium dollars from all of the other policy owners at the carrier into something called a risk pool. And that risk pool is ultimately used to pay out claims for anybody who dies with an active policy inside that pool. And with a mutual insurance carrier, essentially what you're doing is you're insuring your life, and everyone is insuring their lives essentially with the contributions of all of the other members of that risk pool. Now, while your dollars get contributed inside this pool, and while they're in there, they don't just go into a bucket and get pushed to into the corner of the room in the janitor's closet and the doors get shut on it. Like, while your dollars are in this pool, those dollars are invested by the carrier into different asset classes like fixed income securities, commercial real estate, venture capital. Like, they don't just sit on your money, right? Like, they're very actively involved with making sure that the money that you're contributing to this carrier is growing. Justin, do you want to say anything about some of those different asset allocations right there, like the fixed income, the commercial real estate, or venture capital?
Yeah, it's definitely something where not sitting on it. They have their own investment teams. They're investing in stuff that is a lot of times safe and secure, as well as I know we'll dive into a little bit more of maybe some more riskier things that have a potential higher growth chance. And but most of it's going to be kind of bond related, all the different types of bonds, and really helping to grow your money while they have it.
Yes. Yeah. They don't. Yeah. They have the long game in mind. Like, they're not looking like a year down the road. They're looking 100 years down the road. And if you have that kind of a long game mentality, like, you got to put your dollars to work today so that in 100 years that there's enough of them in the future to do what they got to do. Absolutely. So ultimately, like, the way life insurance, like the almost philosophy behind it, or like what makes it functional, is that so there's a death benefit that would essentially, if you added up all the death benefit of all of the policies of all of the policy owners at the carrier, that death benefit is going to generally be much larger than the premiums that are going to get paid into them that year. So like all of the policy owners, that's huge. And the amount of premium that's getting paid a year is much smaller. So there's a delta there, right? There's a difference between the two. And ultimately, there has to be something to make up for that difference. Now, ultimately, not everybody's going to probably die in the same year, which is kind of why this works. And then there's also, there's mechanisms in place that Justin's going to talk about later, which, essentially relate to, what how the the safeguards in related to life insurance. But, ultimately, what the life insurance carrier is betting is that, and how they're able to remain fiscally sound, is that they're saying, hey, I'm making this corporate bet across all of the policy owners that if everybody is paying premiums into this year by year, that they're going to be doing this for a long enough time that we're going to be able to make up the difference between future death benefit payouts to all the beneficiaries and the total premiums funded by all policy owners by the earned interest in your dollars as investments in the interim years. So they're essentially saying, hey, over time, we're going to be able to take the money that you give us, and we're going to grow that. So in the future, when you do die, and when other people in the carrier also pass away, that we're going to be able to pay out on those death claims and still remain financially sound. So that's like the premise, right? Now, I've captured a couple different asset class allocations of several different carriers. Some of these we work with, some of which we don't. And I just think it's really cool to see that, like, even though these are all different carriers, there's so many similarities. And I want to just kind of nerd out on this for you, with you on this for a second, Justin. So this asset class allocation with this one carrier, as you see, bonds, 71% of their invested assets. Now, with this carrier, so bonds, I'm sure many of you know, that's a fixed income security. All the carriers that we work with are heavily invested in bonds. The reason why is that it is a very time-honored strategy. It gives you fixed income over a long period of time. And there's different kinds of bonds, and we're going to go into that a little bit more in a couple slides. But ultimately, bonds are it's a very safe strategy, and these carriers, they want safe strategies to grow their money. They don't do the newest, the coolest thing. Like, they're going to use time-honored, time-honed investment strategies. Commercial mortgages, and then number 3 there, that's 10% for the commercial mortgages, 7% for policy loans. This is what I think is really cool, and I think this actually deserves some content in a later video, because some people ask me, like, hey, Austin, like, is policy loans like where I pay interest myself? And this is actually, I think, like probably the clearest way to show you that no, in fact, policy loans are not you paying interest to yourself. That might be where infinite banking enthusiasts get a little overzealous. As you see here, policy loans are actually counted as profit of the carrier. And you might ask why. Why is it counted as profit? It's because when a carrier gives you a policy loan, they're taking money out of the general fund where it would be earning X% interest in whatever of these investments that they have it in, and they're giving it to you. And because all of the dollars of the carrier have to do work for these carriers over not decades, but even centuries, they need the dollars, even if they leave the carrier, to still be working for them. So they're essentially going to forward you the interest that they would have earned had it stayed in the carrier to you as a policy loan interest rate. So that essentially becomes the policy loan interest rate. And when you pay that policy loan interest rate, that's going to essentially end back up in the profit of the carrier and in the general fund. And indirectly, it will get shared with all policy owners. So indirectly, you will benefit from it, but you're not, literally paying interest yourself. Like, it's a policy loan, right? It's the profit of the carrier. And then as we go on, further, private and real estate equity, affiliates, public equity, cash. The next one, different one. As you see, bonds, once again, very high number, 73%, 12% for their mortgage loans. Their policy loans are only 4%, right? So, so once again, every carrier is a little bit different, but there's a lot of things that rhyme here. So this is a cool carrier that they actually kind of broke down, not just like how much percent of their general fund was fixed securities and bonds, but like what kind of bonds that they had. And right, so here you see like 26% is public investment corporate bonds. 18% is private investment grade corporate bonds. And then over on the left-hand side, you see over there's U.S. government securities, which it's actually funny like how, even though there is some U.S. Government bonds in here, it's how little there are, is that they're actually much more into private investment grade corporate bonds and public investment grade corporate bonds than they are U.S. government bonds. Because I don't know about you, Justin. Usually when I think about bonds, I think of U.S. government bonds, like the 30 years or whatever. But that's clearly like they're using strategies that are, that they're really smart. They know what they're doing, and they're very invested into different kinds of bonds than that.
Yeah, definitely something I think probably a majority of people just think of, a bond, like, yeah, a government bond, but there's all types of different bonds, and they are heavily invested in there. And you see that it's a very low percentage across probably most of the companies that are actually in government bonds. They definitely do have some, but you see there's a lot of different types of bonds, and investment grade bonds, meaning they are safe, secure as well, based on strong companies in most cases.
Absolutely. Another carrier, as you see, even a little bit higher, they combined their investment grade bonds and their cash reserves, so 79% of those. And then on the other side, venture capital, so below investment grade bonds, mortgages, real estate. There's just a lot to be seen here that like all these carriers, these are all different. And some of these carriers, as you see right here on the right-hand side, this carrier has $246 billion inside the general fund. Not all carriers are that big. Some of them only have $50 billion, but only $50 billion, like 50, anything with a billion as like the second word is a massive number that my tiny brain can hardly wrap itself around. Like, it's more money than I'll ever see in my lifetime. And all of these carriers are investing in similar things. They have similar strategies. And if all of these are doing the same thing, that should be telling us that, hey, like, these strategies are like generally agreed upon to be working. And these institutions that have been around for over 100 years and have made good on all of their payouts during that time, that like these institutions, like, there's something to it, and that they're surviving because they're applying these strategies, and these strategies have worked across the decades and even the centuries. And so I think that's super cool. So and this, even though it has the word Bitcoin in it, this is something that that I wanted to highlight a little bit here. So we just talked about how like they're making these, so all these carriers, they're using these time-honored strategies. Bitcoin is not a time-honored strategy because it only came around in 2008. So, you know, why does this deserve a spot here? So just to give you an idea about how like tenderly and how almost like gingerly some of these mutual insurance carriers are stepping into like some of these alternative investments is, you know, Bitcoin has been around since 2008. It's 2020 is when this article starts, is that in 2020, Mass Mutual, which is one of the biggest mutual insurance carriers in the US, they invested $100 million into Bitcoin in 2020. And by this time this article was written in 2024, if they had held on to all that Bitcoin, which we don't know because Mass didn't publish it or anything, if they had held onto all of it, which once again, this is a mutual insurance carrier, they hold on to things for a long time. If they held on to all of it, it would have grown to about $500 million. And you're like, whoa, that's a $400 million jump. Why don't they put all their money into this? Justin, you want to talk to that? Why doesn't Mass just take all? And at this time, as you see in 2020, and this is something you would have read if you read the article, in 2020, Mass's combined general fund held $200 billion. Why wouldn't they have put all $200 billion into their Bitcoin back in 2020? Do you want to talk to that, Justin?
Yeah, it's definitely something where they, just like we talked about, are investing in things that are very more than likely to continue to pay out and grow, even though not at a very, very high rate, where Bitcoin obviously went from 100 million to 500 million. And so they, because of that safe foundation and the tried and true of what they have been doing for a very long time, it allows them to go out and take those other risks where, hey, we can have this over here where we're going to invest in things with a higher chance of growing at a much higher rate. And then therefore that increases the overall returns of everything. But it starts with that foundation. I'll say very similar to what a lot of our clients look at life insurance in their personal lives for. Hey, I have this safe foundational asset over here. I know my money is going to be in there. I know I can borrow against it, that then I can go out and make other investments, perhaps take more risk in other areas because I have this safe foundation over here. Now, probably it's going to be a lot less zeros than maybe the billions of dollars that Mass Mutual has, but we can still take a little bit of what they're doing and learn from it.
We can dream, right?
Hey, I'll check my piggy bank and see what I have.
Yeah, check in between your couch cushions, the mayonnaise jars, everything. That's right. Yeah. We like to think better, just like Justin said, like, yeah, life insurance is this anti-volatile asset that can help you. It's a safe asset that can actually help you show up more powerfully to your other more volatile assets inside your portfolio, since you have this one that's behaving in this very predictable way. And Mass is, once again, they're doing to Bitcoin what they essentially do to everything, is they're playing the risk game. Is they're like, we don't really know if this is going to work out, so we're going to invest a teeny tiny amount of our general fund into this, and the amount is significantly less than 1%. I'll show you on the last slide just how much 100 million is a percent of 200 billion, but it is a super teeny tiny percent of 200 billion. So now we're going to get to some of the questions that we've gotten, right? So hand over the hearts right here. So questions that we've gotten related to the security of life insurance and the US government and just kind of like geopolitics, world, situations. Justin, tell me if you've had these questions from your clients, because I certainly have. I'm curious to hear how you might have answered them. So what happens if the dollar collapses or the US government falls? I've gotten this question before. Justin, how have you gotten this question? And if so, how have you answered it?
Yeah, it's definitely something that I don't say I get it all the time, but have had it enough times where it's something where, what if everything collapses, or what if the whole financial system goes down? And so really the answer to that is there's probably a lot of other things you're going to be worried about in that situation. I like to tell people there's a saying that, hey, do 99% of your planning for the 99% probability, meaning let's put most of our planning into what's more than likely going to happen. So the chances of the government failing, everything failing, is maybe there's a chance, but it's highly unlikely. If that were the case, you would be putting all of your money into, hey, probably getting food, making sure you have water, guns and ammo, different things like that. But you don't want to put all of your
Mhm.
money there. So when we talk about
Mhm.
it being a safe and secure asset, we're comparing it to other things like other financial institutions, other banks, putting money under your mattress, different things like that. And it's going to be safer than that because if everything goes down, then everything goes down and you're not so much
Everything goes
worried
down.
about my life insurance
Yeah.
policy.
Yeah. I like to tell people like, okay, just hypothetically, yeah, if dollar collapse, U.S. government fails, like, yeah, your policy is not going to be doing so hot, but nothing in your entire portfolio is going to be doing hot either. And yeah, like there's going to be food shortages, there's riots in the streets, there's new countries forming, like there's a whole lot of other contingencies, and your life insurance policy will probably be the least of concerns of yours at this point. But I also like to remind people like, hey, even in a scenario where you start to really doubt the longevity of the institutions that you've grown up with, the great part about these policies is that they're liquid, right? That you can liquidate them, you can borrow against them, you can withdraw from them depending on how old your policy is, and you can use that to invest in something alternative to it. Now, granted, don't if you do that and then the government doesn't fall and everything, like there's going to be consequences. So make sure that you really think about it before you do that. But ultimately, these are liquid policies, and it's not like you don't have access to the money once you put it in here like a CD. Like you have the ability to withdraw or to borrow against the cash value, and you can use that to put it in something alternative. But like what Justin said, like in the 1% chance that something really bad happens, like okay, maybe you want to put it in real estate. But in real estate, really all your mortgages is a piece of paper that says you own it. And if you're in some Red Dawn sort of scenario, people are gonna laugh at you and they say, oh, that's a nice piece of paper you got here. Like my gun's bigger than yours. So like once again, like we do your 99% of planning for the 99%, and the 1%. Like okay, like think about it, but it is the 1%. Another question that I get is where do the dividends come from? Easy question, a little bit of an easy answer. People are like, this seems kind of hocus pocusy, magical. Like to the dividends are your share of the profits of the carrier, and like what we already talked about, when you give the life insurance carrier money, they don't just sit on it; they actually put it to work, and they put it into bonds, they put it into venture capital, they put it into commercial real estate. They have all these different lines that they put it in, and that makes up the general fund. So all of the profit that you get to experience as the policy owner comes from all of the combined premiums of all of the policy owners that have gone into the general fund, and then everything that's been in there before that has been earning interest for a very long time, and you get a share of that every single year. That's where the dividends come from. And then lastly, is there a government-backed guarantee? Justin, do you want to explain, like, flesh this out a little bit? Like, is there a government-backed guarantee? How does that work?
Yeah. So there is different regulations that are essentially in place. So one is every state has some sort of state guarantee association that is there in place to help if for some reason a life insurance company were to fail, that there would be kind of some help with the ability to continue paying out claims. Now, most of the time, like you alluded to earlier, there are reserves that have to be met where they have to have some money on hand to pay out the claims. And so if everyone died, then maybe they don't have enough to pay out that. But if the majority of people died, especially the companies we work with who are A+ rated, a lot of times that means they have more of a surplus, more reserves, so they are more financially sound to handle a worst case scenario. If they can't, then there's a state guarantee associations that come in and help. But there's also the opportunity for reinsurance, meaning another bigger company that wasn't affected comes in and can help in that way too. Something maybe a lot of people don't know is actually, if you're very wealthy and get insurance and it's a very big policy, a lot of times it's not just one company taking that policy. It's split between a couple so that they're still mitigating their risk even through that potential avenue there.
Wow. Yeah. So yeah, there's just a lot of different layers of safety, basically, is what I'm hearing from you, Justin, and security to this is that, in the 99% chance that, civil society, continues as it is, that, even if there's economic turbulence, that there's safeguards in place at several levels, even if one of those levels were to go a little bit awry.
Yeah, it's something where it's like the likelihood of one failing this financially sound is very low. But if that were to happen, there's multiple layers in place that are also there to help you.
Yeah, absolutely. Okay. So that pretty much takes us to the end here. And that essentially like, so where have we been? What is the upshot? So the life insurance carriers aggregate risks that no one person can handle on their own. That's important. And high grade life insurance carriers are incredibly risk averse, right? They use time-honored, time-honed investment strategies that have worked for decades and centuries. Life insurance carriers don't make plans just looking 10 years into the future. They're looking 100 years into the future, right? They're looking past maybe even Bitcoin or all the things that are cool and trending right now, and they're like, okay, what's still going to be around that's still going to be producing so that our policy owners that we can still make good on any claims that are made. And part of the reason is they're looking 100 years in the future is because they're entering into 120-year contracts with you, right? Your policy, if you look at it, you look all the way down, it goes to year 120. And if you live to year 120, somebody from that carrier will probably fly to your house, and that's the point of your policy would mature, and they would just hand you a check for essentially the cash value and death benefit, which are equal to each other at that time, and they'd say congrats because you have made it, right? You've made it to 120 years old, so good job. But that is why they're looking into the future, right? Is they're saying, hey, like I have this really long contract with them, I need to be fiscally sound for this entire time. They need to be fiscally sound for generations to come. And like I promised, I would tell you exactly how much of MassMutual's fund that Bitcoin investment was. It was 0.00036%. Like that's how tiny that 100 million is in relation to 200 billion. So once again, these are very safe, very conservative institutions that they don't take a lot of risks, and they've survived world upheaval, right? There's a carrier we work with, they've been through the American Civil War, they've been through World War I, the Great Depression, World War II, they've been through the Cold War, they've been through the Vietnam War, they've been through the dot-com bust, they've been through the pandemic, they never missed a dividend payment. Like they've just been chugging along the entire way, without really, like I said, they made a dividend payment every single year. And there's not a lot of other institutions or organizations that like can claim that. But once again, these institutions have been around a very long time. They don't take a lot of chances. Even when the world was, genuinely like scarier than it is now. Like I think like, Hitler in 1939 to 1941, like when he's on his blitzkrieg in Europe, like 1939, 1941, when it seemed like maybe the world would like be like coalesce under a single superpower. Do you know who paid dividends? Every single carrier we work with. Like every single carrier that we work with paid dividends in 1939, 1940, and 1941. And like we said earlier, Red Dawn, it's a great movie to watch, but maybe not such a good movie to plan your investment strategy around. Like, so plan for the 99%. Like, maybe something like that does happen, but then you'll have way bigger concerns to worry about. Life insurance historically has been seen as a very safe and secure asset that is not actually something that you have to worry about itself in terms of risk. Life insurance has actually been seen as itself a hedge against risk. The risk and the different vicissitudes of life. So ultimately, it's a very safe asset to have. Very few other financial assets have been around as long as life insurance and have the track record of life insurance. So a great one to put your money into. Any other thoughts, Justin? Anything?
Yeah, I think it's definitely the way to look at it is this is a way to mitigate your risk. You put money in here, it's going to be safe and secure. And I know we have a couple of videos on the Better Wealth channel that are the CEOs of a couple of these companies, and with them being interviewed, so you can hear straight from them about how they run their company, some of the things they do, and they can dive deeper into the details of, hey, how exactly are they helping grow that money? How exactly are they making sure that their risk is mitigated? And so I'd say take a look at those. And if you have questions, of course, give Austin a call, give me a call. book
That's
a
right.
call, and we'd be happy to help dive into your specific scenario, answer your specific questions, and see if this is something that makes sense for you.
Absolutely. Couldn't have said it better myself. Yeah. So with that being said, thank you for watching. It was a pleasure for us to bring this for you, and we look forward to talking to you soon.